You can destroy your financial future with one signature, and it won't feel like a mistake for 5 years. You'll be standing in a parking lot staring at a car you technically can't afford, not in cash, monthly. The numbers look neat, comfortable, almost polite, and that's the problem. Most financial damage doesn't arrive loudly. It arrives in clean fonts and small monthly payments. A few years later, you're earning more, working harder, and somehow still stuck. Same income bracket, same stress, different excuses. This is the part nobody really talks about. Cars aren't just transportation anymore. They've become one of the most efficient debt machines in modern life. Let me explain this simply. Two people, same age, same job, same salary. One leases a new car. The other buys something boring and invests the difference. Same income, different balance sheet. At first, they look identical. Both show up to work, both get coffee, both complain about traffic. But under the surface, something very different is happening. One is slowly stacking assets. The other is quietly renting a lifestyle. And the strange part? The monthly payment doesn't look dangerous. That's why it works. Cars used to mean freedom. Now they're structured like long-term financial gravity. You don't feel the pull at first, you just notice you're not moving. Here's the system. First comes emotion, status, safety, reward. You're not really buying transportation, you're buying a feeling. Salespeople know this. They don't sell metal, they sell identity. Then comes the shift. Not what does this cost, but what can you afford per month? That single question quietly changes everything, because once the conversation moves to monthly payment, the real price disappears. Loan terms stretch, 5 years, 6 years, 7 years, sometimes longer. Today, 72-month and 84-month car loans are normal. That's half a decade or more of paying for something that's shrinking the entire time. And most of your early payments, they don't touch the car, they feed the interest. By the time you've paid a meaningful amount of principal, the value has already leaked out. New cars typically lose around 20% in year 1, another 15% in year 2, about 10% in year 3. Same car, same engine, nearly half the value gone. You're paying for something that's running downhill. This is reverse compounding. Your money is working, just not for you. In the US alone, auto loan debt is now around $1.6 trillion, and the average new car payment just crossed about $700 a month. That's rent for something that rusts. About 1 in 4 trade-ins today has negative equity, meaning the owner owes more than the car is worth. That's not bad luck, that's design. Here's how the loop usually looks. Emotion, monthly payment focus, long loan, depreciation, negative equity, trade-in, repeat. It's a treadmill that speeds up every time you think you're upgrading. Each cycle feels reasonable. Each one digs slightly deeper. Let's put numbers on it. Say someone buys a $50,000 car. They put down $5,000, finance $45,000. At around 7 to 12% interest, on a 72-month loan, that's roughly $780 a month. Total paid about $56,000. On an 84-month loan, maybe $690 a month. Total paid around $63,000. Lower payment, higher cost. Now fast forward 3 years. The loan balance is still around $33,000. The car's market value is closer to $28,000. They're underwater by about $5,000. So they trade it in. The dealer smiles, rolls the old debt into the new loan, and the treadmill speeds up. This is why people feel like they're always paying for cars but never owning anything meaningful.
Now compare that to the boring path. Same $40,000 decision, but instead of metal and leather, it goes into a simple global stock index fund. At around 8% a year, in 10 years, about $86,000. In 15 years, about $126,000. In 20 years, around $186,000. No talent, no timing, no excitement, just time doing its job. The real cost of the car isn't the sticker price, it's the future that never showed up. Opportunity cost is the most expensive bill in finance, and it never sends reminders. There's also inflation, the quiet leak. Fuel rises, insurance rises, repairs rise. Your loan payment stays fixed, but everything around it gets more expensive. So the car is losing value, and your money is losing time. Double erosion. Again, not dramatic, structural. Dealerships add another layer. They juggle 4 numbers: price, down payment, trade-in, monthly payment. Your attention moves, your energy drops, monthly payment becomes the only thing that feels real. Then comes time pressure. This deal ends today. Another buyer is coming. My manager just approved this. It's not about the car, it's about closing the loop. Prices didn't help either. Chip shortages, low supply, suburban demand, inflation near 9%. Expensive cars, weaker buying power, longer loans. Quietly perfect conditions for debt. Now, this isn't anti-car. You need to move. You need to live. This is about structure. Buying transportation versus financing identity. A reliable used car is boring. Financially, boring is beautiful. A new car is exciting. Financially, excitement is expensive. Same road, different trajectory. Here's a simple comparison. Person A leases for $600 a month. That's $7,200 a year. Over 10 years, $72,000. They own nothing. Person B buys a used car for $15,000, invests the $600 monthly instead. After 10 years, that investment alone is roughly $105,000. Same salary, same decade, different gravity. This is capital stacking. Assets make the next asset easier. Liabilities delay everything. Banks see risk differently when you own productive things. Loans get cheaper. Options expand. Not instantly, but structurally. When your name is attached to depreciating metal, you stay in the consumer lane. Working, spending, resetting. Nothing immoral about that, but it is expensive. Insurance, maintenance, upgrades, tires, parking. Every month, another quiet withdrawal. None of it compounds, it just evaporates. Now, if someone is already stuck in a car loan, the path forward isn't dramatic. It's boring. 3 doors. 1. Attack the principal aggressively. 2. Refinance if rates dropped or credit improved. 3. Sell and accept the loss. Everything else usually makes the hole deeper, including trading down. Voluntary repossession is the emergency exit. It doesn't just take the car, it takes your credit with it. Again, not moral, mechanical. For new buyers, structure matters more than taste. Get financing from a bank before stepping into a dealership. Look at the full cost: payment, insurance, fuel, maintenance, and keep the car small relative to your income. Roughly 20% down, 4-year loan max, total car cost under 10% of monthly income. Not exciting, but excitement is overrated. Now the investing layer. Boring on purpose. Low-cost index funds, broad ownership, low fees. Time. That's it. Fees matter more than horsepower. A 1% fee sounds harmless. Over 30 years, it quietly eats more than most cars ever cost. It's the only bill that grows when your money does well. Banks call it a fee. I call it rent. Another quiet shift happens once you own your first real asset. Spending feels heavier. Saving feels lighter. You start thinking in years instead of weekends. That's when the system changes its tone toward you. Not friendly, just different. Between 2003 and 2023, markets survived crashes, wars, pandemics, rate hikes, and several moments when everyone said the system was ending. A boring index investor roughly quadrupled their money anyway, not because they were bold, because they stayed. So what do people with money usually do when choosing a car? They don't ask how it looks, they ask what it delays. They don't ask what fits their monthly budget, they ask what it costs over a decade. Same income, different questions. Most people think wealth starts with earning more. It doesn't. It starts with leaking less. It starts when your money stops evaporating and begins showing up with friends. And once that starts, the system changes its tone toward you. Not friendly, just different. And once that starts, the car becomes what it was always meant to be, a tool, not a trap.